Welcome to the Trendline Gala podcast.
Today we are strapping in for a very practical look at how people actually trade in the market.
Right, not just passively invest for retirement.
Exactly. We are going to break down the different ways people buy and sell financial assets, like stocks, trying to make a quick profit from short-term movements.
Okay, let's unpack this difference right away because it's, I think, a crucial starting point for anyone new to the market.
It really is.
When most people think about investing, they think about the buy and hold approach. That's passive investing. You buy a stock in a company you believe in, and you hold it for 5, 10, 20 years.
You're waiting for that company to grow to provide for your retirement down the line.
Yeah, exactly.
Yeah.
But the people we're focusing on today, they are active traders.
Active trading is a completely different ballgame. It's a high-speed sport focused entirely on volatility. The entire goal is to make a quick profit from price fluctuations.
So we're not talking years. We're talking what?
We're talking minutes, days, or maybe months. You are not waiting 20 years for a company to grow. You're trying to capitalize on the movement of the price right now.
And what's fascinating here, and what we're going to get into, is that even within active trading, there are totally different rhythms. Almost like musical tempos, They can range from this frantic electronic beat to a slow, methodical symphony.
That's the perfect way to frame it. Traders choose a style based entirely on one single thing: how long they're willing to keep the asset.
The time frame.
That's it. We're talking about time frames that span from literal seconds all the way out to years.
And understanding these three main rhythms, the speeds at which people trade, is absolutely key for you to avoid, just information overload.
Oh, absolutely. It's so easy to get lost.
If you try to learn a day trading strategy when you really only have the time commitment for, say, position trading, you are just setting yourself up for failure. So our mission today is to clearly define these three main styles: day trading, swing trading, and position trading, so you can understand the time, the risk, and the stress commitment required for each.
Let's walk through these rhythms, starting with the fastest one, because that's where most beginners usually mistakenly try to jump in first.
Let's do it.
Okay.
So let's jump right into the fastest tempo on the drum kit: day trading. This is the definition of high-frequency market activity.
It is. Day trading is defined by speed and immediacy. It's a short-term trading strategy where a security is bought and sold.
Or sold and bought.
Right. Or sold and bought within the exact same trading day. When that market closes at 4:00 p.m. Eastern, a pure day trader has 0 open positions. Everything is flat.
So let me make sure I get this. If I buy 100 shares of a company at 10.50 in the morning,
Yeah.
the trade isn't really done until I sell those same 100 shares at, say, 3.50 in the afternoon.
Correct.
That entire round-trip buy and sell has to happen between the market open and the market close. If I hold them overnight, even by 1 minute,
You are no longer a day trader for that particular position. You've crossed into another style.
Okay.
Precisely. Day traders are aiming to profit from very small price movements that happen over, minutes or hours.
not big sweeping trends.
Not at all. They're focused almost exclusively on what's called technical analysis. So they're looking at charts, at volume, at momentum indicators, all to predict where the price is going to wiggle next.
And they're not really concerned with the company itself, like their earnings or their big 5-year plan.
Less so. They're typically less concerned with the company's fundamental value, like their balance sheet. They just want the stock to move. For them, volatility is their friend.
I think the best way to picture this is with a metaphor. You can think of day trading like trying to surf every little tiny wave on a very busy ocean.
I like that.
The waves are these micro movements. They come constantly. And if you miss one, you immediately move to the next.
And you have to be incredibly fast, active, and watch the water constantly.
Yeah. If you pause for a minute to, check your phone, you might miss the one little wave that could have made you a profit.
That analogy captures the reality well, but it also, and this is important, it also highlights the cost.
What's the cost?
Day trading is extremely demanding. We know from all the beginner guides that it's very fast-paced, which makes it incredibly stressful.
And emotionally draining, I'd imagine.
Oh, absolutely. It demands that traders watch multiple screens with real-time data feeds, constantly analyzing changing market conditions, news headlines, order flow.
All at once.
All at once. And you have to make many quick decisions under intense pressure.
And the competitive landscape here is just It's brutal, right? You aren't just trading against other individuals sitting at home.
Not even close. You are competing against massive institutional funds and, more importantly, high-frequency trading algorithms that can execute trades in microseconds.
So as an individual, you're often relying on these little market inefficiencies that those algorithms might see and close in an instant.
That dramatically raises the risk profile. It's a very sharp game.
So while the potential for profit on a single trade might look high, we have to be really clear here.
Yes, we have to be clear. This is a high-risk trading strategy. Most studies and beginner guides, they all explain that many novices lose a significant amount of money when they first start.
And why is that? Is it just because it's hard?
It's largely because they underestimate the discipline and the sheer speed required. It's a skill you have to build.
However, there is one significant advantage that day traders have that the other styles don't, right?
And there is. It's the absence of what we call overnight risk.
Okay, what is that?
It's critical. Since day traders close all their positions before the market shuts down, they are completely protected from sudden market events or bad news that happens overnight.
Like an unexpected earnings warning from the company.
Or a natural disaster, or a major geopolitical announcement, anything that might just crush the price of the stock while they're sleeping. They get a fresh, clean start every single day.
That's a huge psychological benefit, I'm sure.
It is.
Now, if day trading is fast, we need to briefly mention the hyper-speed version of this, which is called scalping.
Right. Scalping is truly the extreme version of day trading, where the time horizon shrinks even further.
So instead of holding a position for an hour or two, a scalper is jumping in and out in, what, literal seconds?
Literal seconds or maybe 1 or 2 minutes max. They're aiming for tiny, frequent profits from micro price changes.
It's just fractions of a cent, maybe?
Often, yes.
Yeah.
They're trying to capture these fleeting gains, but they do it hundreds of times in a single day. Your surfing analogy is good, but this is like trying to drink from a fire hose of tiny opportunities.
That sounds exhausting.
And we want to be incredibly clear to you, the listener. Scalping is an advanced, high-intensity technique.
Beginners should not start here.
Definitely not. The sheer mental workload is immense. But beyond just the stress, there's a really practical reason. Transaction costs.
The fees.
Exactly. Because you are trading so frequently, the transaction costs things like commissions and, very importantly, the bid-ask spreads can be considerable.
And they can eat up your profits fast.
They will quickly eat into any small profits you manage to make.
Okay, let's explain the bid-ask spread simply. What is that?
So, if you're trying to buy a stock, there's the price a seller wants, that's the ask, and the price a buyer is willing to pay, that's the bid.
And the difference between those two numbers is the spread.
Correct. A scalper needs the price to move enough just to cover that spread, plus their commissions, just to break even on the trade.
And to do that successfully hundreds of times a day.
It requires incredible technical precision, extreme discipline, focus, and rock-solid risk management. It should really be seen as the absolute pinnacle of speed in active trading.
It sounds absolutely exhausting just thinking about the constant pressure. But there are rules around this, right? Rules around how fast you can trade, especially if you're using leverage.
Yes. Using a margin account, which lets you borrow money from your broker.
Let's look closer at the regulation designed to manage this risk. The pattern day trader rule, the PDT rule.
This is one of the most important rules for anyone even considering high-frequency trading. The PDT rule was established by FINRA.
And FINRA is?
That's the Financial Industry Regulatory Authority. They're the body that basically polices brokerages and protects investors. And this rule was put in place specifically to manage the high risk inherent in frequent trading.
Okay, so how does FINRA define this high frequency? When do you get this label?
You are officially considered a pattern day trader if you execute 4 or more day trades within any 5 consecutive business days.
4 trades in a week, basically.
Right. And this part's important. Those day trades have to make up more than 6% of your total trading activity in that margin account during that same 5-day period.
So it's about both the volume of trades and how much of your activity is day trading. But the key here is that it applies to a margin account, right? An account where you can leverage your cash.
That's a critical distinction. If you use a standard cash account where you can only trade with the money you have fully settled.
So just your own money, no borrowing.
Exactly. You are generally not subject to the PDT rule. You can day trade as much as you want, but you have to wait for the cash from the previous sale to settle, which usually takes 2 days.
Ah, T+2 settlement. So you can't just flip the same money over and over again on the same day.
You can't, and that's why many day traders use margin. They need the leverage and the ability to immediately reuse their capital. And that's when the PDT rule kicks in.
And once you are flagged, once you're coded as a pattern day trader, what's the immediate consequence that you need to be aware of?
The most important rule for the listener to understand is the $25,000 minimum equity requirement.
The $25,000 rule. Why does that minimum exist, and what does it actually mean in practice?
This minimum equity requirement exists precisely because day trading with leverage is so risky. I mean, think about it. You might be taking on 4 times the buying power of the cash you actually have.
The broker needs to be protected.
The broker needs protection against you incurring massive losses that you can't cover. The $25,000 acts as a regulatory cushion. It's there to protect both you, the trader, and the brokerage firm that clears the transactions.
So it's a safety buffer against the incredible speed and volatility of what you're doing.
Exactly. You must maintain minimum equity of $25,000, and that's a combination of cash and eligible securities in your margin account on any day that you day trade.
And crucially, that money has to be there before you start trading for the day, right?
Yes, before you start your day trading activities for the day. If your account equity drops below that $25,000 threshold, even by $1,
What happens?
you are immediately restricted from making any further day trades until you put the funds back in and bring the account back up to the minimal.
So this means that whole influencer-driven dream of starting day trading with, like, $500 and making a quick fortune,
It's fundamentally impossible if you want to trade frequently in a margin account.
unless you stick solely to a cash account, and you're willing to wait 2 days between every single trade for the cash to settle.
Right, you just can't be a high-frequency day trader with low capital under these rules.
So that's the takeaway we want to emphasize here.
It is. If you break the PDT rules, or if you exceed your buying power, the brokerage can issue a margin call. And if you don't meet that call, meaning you don't add enough cash to bring the equity back up, you could be restricted to trading only on a cash available basis for up to 90 days.
It effectively sidelines you from the game.
Completely.
It's a very strict system that underscores a foundational warning, really. Day trading is generally not appropriate for someone with limited resources, limited experience, or a low risk tolerance.
Right. It requires not just the $25,000, but a thorough knowledge of technical analysis, strict discipline.
You have to plan the trade and trade the plan.
Always. And you need the mental fortitude to handle constant stress and, frankly, immediate losses. Without that discipline, the fast pace just guarantees emotional trading decisions.
Like panic selling or revenge trading.
Exactly. Day trading demands that you master yourself first, long before you can even attempt to master the market.
Okay, so if day trading is a full-out sprint that requires constant frenetic attention, let's move to the middle ground. Something that feels much more like, say, a 10K road race. Swing trading.
A great comparison. Swing trading is significantly slower than day trading, placing it squarely in that middle ground between minute-to-minute activity and multi-year holding.
And the goal is different here, right?
The goal here is to capture price moves that last from a few days up to a few weeks, or sometimes even a few months.
Okay, so the idea is built on the reality that markets rarely move in a straight line up or down.
Exactly. Even in a strong long-term trend, prices swing back and forth. They establish higher highs and then lower lows in a sort of rhythm.
And a swing trader is trying to identify these natural swings or turning points and just jump on for the ride for a little while.
That's it. They're capitalizing on short to intermediate term movements. They're looking for moments when a stock has moved too far in one direction, it pauses or reverses briefly, and then is likely to resume its original trend.
So they're looking for pockets of what's called support and resistance.
Right, support, where buyers tend to jump in, or resistance, where sellers tend to jump in. They enter the market when a counter trend move seems to be ending and the dominant trend is about to resume.
This is where my other analogy comes in because it clarifies the time difference immediately. If day trading was surfing every tiny splash, swing trading is like riding part of a bigger, more solid wave. You wait for a clear, established move to form. You jump on, you ride it for a few days or weeks to capture the bulk of that momentum.
And then you get off.
And then you get off before the wave completely reverses or crashes. You're not worrying about every tiny little wiggle along the way.
And this change in time frame fundamentally changes the entire experience, which is a massive benefit for you if you have a day job.
Right, because you don't need to be glued to the screen.
Swing traders don't need to stare at the screen all day long. They might spend an hour or two in the evening analyzing charts and then check in briefly during the day for execution or to manage their position.
And they're looking at different charts, I assume.
Yes, they primarily focus on daily or 4-hour charts rather than the 1-minute or 5-minute charts that day traders live on.
So because they have more time to analyze the trends and the chart patterns, they can make more informed, more deliberate decisions.
It significantly reduces the risk of those fast, emotional decisions driven by panic or fear that can really plague day traders who only have seconds to act.
You actually have time to think.
You have time to think and plan your entry and your exit points logically.
So what are the tools they use? Is it still technical analysis?
The typical toolkit for a swing trader relies heavily on technical analysis indicators, but they're applied over these longer time frames. For example, they frequently use the Relative Strength Index, or RSI.
Okay, let's break down the RSI for the listener. What is it, simply?
Simply put, the RSI is a momentum indicator. It measures the speed and the change of price movements.
Okay.
So traders use it to determine if an asset is overbought, meaning the price has moved up too fast and is likely to drop soon, or oversold.
Which means the price has fallen too fast and is probably due for a bounce.
Exactly. So a swing trader might wait for the RSI to signal that a stock is oversold, suggesting a buying opportunity is near before they enter the position.
And they also rely on things like the moving average divergence, the MACD indicator, right?
Correct. The MACD is great for identifying the strength and direction of a trend. It looks at two moving averages, basically, the average price over a short period and the average price over a longer period.
And when those lines cross, it means something.
Right. When the faster average moves away from the slower average, it signals momentum. And when they cross, it often signals a potential reversal. Swing traders use these crosses as critical entry or exit signals.
These tools give the swing trader a systematic, kind of repeatable way to find opportunities without needing that constant minute-by-minute attention.
They do.
But what's the catch here? Because every rhythm has a trade-off. What's the downside?
The major trade-off is that overnight risk we mentioned earlier.
The thing day traders avoid.
The very thing. Unlike day traders, swing positions are held overnight, they're held over holidays, and often over weekends. This means they are fully exposed to sudden market events or news that happens while the market is closed.
So let's imagine a swing trader bought shares on a Friday afternoon expecting a strong open on Monday. But over the weekend, I don't know, the CEO of the company is involved in a major scandal.
That's a perfect example. A terrible one, but a perfect one. When the market reopens on Monday morning, the price could gap down.
Meaning it opens significantly lower than where it closed on Friday.
Right, and that gap means the swing trader might incur a massive loss that even their stop-loss order can't protect them against.
Why not?
Simply because the market moved too far, too fast before trading could even resume. The first available price to sell at is already way below their stop.
Wow. Okay, so that overnight risk is a critical factor that swing traders have to manage.
They do, often by reducing their position size or diversifying their positions so no single event can wipe them out.
But on the plus side, you have reduced transaction costs compared to day trading, right?
A big financial incentive. They trade far less frequently, maybe a few times a month instead of dozens of times a day, so commissions and fees are much lower.
Which is why, for many beginner guides, swing trading is often seen as a more realistic starting style than day trading.
It is. It's less time demanding, it's less intense, and it gives you time to build your skill and discipline without that constant draining pressure of intraday volatility.
You get to learn at a more sustainable pace, and you don't have to put up that $25,000 up front.
Correct. It occupies a nice middle ground. It's more active than passive investing, offering that potential to maximize short-term profits by capturing those major market swings.
But it doesn't force you into that highly competitive, high-frequency day trading environment.
You can build confidence by waiting for a clearer picture to emerge on the chart. And if you can be honest with yourself about managing that overnight risk, the slower pace allows you to be much more systematic and less emotional.
Which is the key to long-term success in any kind of active trading.
It's everything.
Okay, that makes a lot of sense.
So now we move to the slowest tempo, the rhythm that's actually closest to traditional investing. Position trading.
Right.
This is where we step off the high-speed trading floor and really just focus on the horizon.
This is where we abandon the surfboard entirely and get onto a large container ship, making a slow, steady voyage across the ocean.
That's a great image for it. Position trading involves holding trades for a very extended period, usually several months, years, or sometimes even decades.
Decades, wow.
It can be. The objective here is to profit from major overarching trends in the market rather than trying to capture the tiny wiggles or even the medium swings.
This style is the polar opposite of day trading. Position traders are deep trend followers. Their core belief is that once a major trend starts,
Whether it's based on technology, demographics, policy shifts.
right, some big macro change,
hmm
it's likely to continue for a long time, and they want to capture the vast majority of that move.
That's it, exactly. A position trader might identify a massive shift, like the long-term trend toward renewable energy infrastructure, or, say, the globalization of the semiconductor industry.
Okay.
They find an asset that will benefit from that, they buy it, and they hold it. They hold it until the trend peaks, or until their analysis shows a significant reversal is underway.
This is where my road trip analogy comes in handy.
Let's hear it.
This is like taking a cross-country road trip.
Yeah.
You care about the final destination and the overall direction of the highway. Are you going east or west? You absolutely do not care about every single stop sign, lane change, or speed bump along the way. Daily price wiggles are just noise that doesn't change the long-term trajectory.
And because they are focused on that macro picture, position traders might place very few trades in a year. Some sources suggest fewer than 10 trades annually. They are highly, highly selective.
And because they're playing the long game, their analysis has to change, right? It can't just be charts anymore.
It changes fundamentally. Unlike day traders who rely on charts, position traders often rely heavily on fundamental analysis to choose their assets.
And fundamental analysis means looking at the underlying health and the value of a company or the asset itself.
Yes. They're asking the big questions. Is this company actually selling more products? Is their debt manageable? Are they gaining market share against their competitors?
So they're looking at things like the price to earnings or the PE ratio, right?
Exactly. The PE ratio is a perfect example of a fundamental metric. It tells you how much investors are willing to pay for every dollar of the company's current earnings.
And if that number is low compared to its history or its competitors.
The position trader might see it as undervalued, a great long-term buy. Conversely, if the PE seems wildly high, they might see it as overvalued and a good time to sell their position.
So they're essentially looking for securities that they believe are fundamentally mispriced, and they're just patiently waiting for the market to correct itself over a long time frame.
That's the game. They might still use technical analysis, but mainly just to identify the optimal entry and exit prices for their long-term holds, not for timing short-term volatility.
Okay, let's talk about the significant advantages of this approach, especially compared to the rapid pace of day trading. Why would someone choose this slow pace?
Well, first, it offers the highest potential gains from major long-term trends. If you catch a multi-year movement powered by, say, a technological revolution, the compounded profits can be massive.
Far outweighing the small gains from hundreds of little day trades.
Potentially, yes. Second, because you're trading so infrequently, you have the lowest transaction costs of all the active trading strategies.
Fewer trades means fewer commissions and fees eating into your returns.
And that alone significantly boosts your overall profitability over time.
And crucially, there's a major tax incentive here that doesn't exist for the other two rhythms.
A huge one. That's right. In many jurisdictions, profits generated from assets held for longer than a year, which is typical for position trading, are taxed at the lower long-term capital gains tax rate.
Whereas the quick profits from day and swing trading are taxed as what?
They're subject to the higher short-term capital gains tax rate, which is often equivalent to your regular income tax rate.
So that tax difference can dramatically improve the final take-home profit for a position trader.
Dramatically. And finally, it's the least stressful in terms of daily attention required. Once the trade is on and your safeguards, like stop-loss orders, are in place, it's mostly a matter of waiting and monitoring macroeconomic conditions.
You are not chained to your computer.
You're not. However, we need to balance this with the drawbacks. There are always drawbacks.
That's cool.
The main one is that your capital is tied up for a prolonged period. This really limits your liquidity.
Your ability to use that cash for something else.
Right, your ability to add new positions or pivot quickly to a new opportunity. If a hot new sector emerges, your cash is locked in your existing positions. That's a real opportunity cost.
And since you are deliberately ignoring that short-term market noise, there's always the risk that those minor price wiggles you're choosing to ignore
can unexpectedly turn into a major trend reversal.
And that could cost you a large chunk of your gain before you can even react. Like a global pandemic could suddenly invalidate years of projected growth in the travel sector, for example.
A perfect real-world example. And there's another psychological challenge for position traders: emotional fatigue.
What do you mean?
Well, if you buy into a position you really believe in, and then for 2 straight years, the stock just flatlines or slowly declines, it can be mentally draining to hold on to that conviction.
I can see that. Day traders get immediate feedback, good or bad.
They do. Position traders have to wait months or even years for confirmation that they were right.
So position trading requires a huge amount of patience, a deep understanding of fundamental value, and the mental strength to endure these long periods of volatility or stagnation without panicking.
You have to trade based on conviction, not just on quick movement.
Okay, let's bring it all together for the learner. Let's create a simple cheat sheet that clarifies how these three rhythms stack up against each other. We can categorize them based on, say, speed, attention, and risk.
That's a great idea. We can use those factors: trade duration, frequency, attention demanded, and the overall risk profile. Those really define the different demands each style places on a trader.
Perfect. Let's start with time held and frequency. This seems like the clearest difference.
Okay. For trade duration, day trading is the fastest, obviously. We're talking minutes to hours, and it's always closed within the same day.
Then swing trading is the middle ground. Days to a few weeks, sometimes a couple of months.
And position trading is the slowest, months to years, or as we said, even decades.
And when we look at how often you trade, the pattern just completely reverses, which really shows the incredible difference in workload.
It really does. So day trading is the most frequent, often multiple times a day, and for scalpers, it can be hundreds.
Swing trading is much less frequent, maybe a few trades a month, depending on how often those medium-term opportunities appear on the charts.
And then position trading is the most infrequent. It's highly selective, sometimes just a handful of trades a year.
Okay, now let's talk about the required time and the emotional energy, because that's where the real-world impact becomes clear for a beginner. Let's look at attention demanded and stress,
Right. Day trading demands the highest attention. You have to watch constantly, monitoring multiple data streams and reacting to real-time events.
which makes it high stress, high intensity, and just emotionally draining. I mean, you are essentially taking on a second full-time job.
You really are. Now, swing trading is in the medium range. You don't have to watch every minute, but you do need to check in regularly, at least daily, or maybe a few times a week, to monitor trends and analyze charts.
The stress is still real, especially with that overnight risk we talked about, but the pace is slower. It gives you that critical time to think and analyze without the clock running out on you.
And finally, position trading demands the lowest attention. You're focused on those major long-term trends. You might review your positions weekly or monthly.
Or only when major news breaks, like a company earnings report or a big shift in government policy.
Exactly. So this makes it the lowest stress option among all the active trading strategies.
And when we look at the risk profile, it's pretty clear.
It is. Day trading and the ultra-fast scalping are undeniably the highest risk, especially for beginners who lack the necessary skill, emotional control, and the capital to absorb immediate losses and compete with the pros.
It's so easy to look at the short-term gains and just ignore the high costs. What's often overlooked is the cumulative financial impact.
Mm-hmm. Active trading inherently comes with higher transaction costs, commissions, and spreads, simply because you are executing so many trades. Day traders and scalpers feel this cost acutely. It can often wipe out marginal profits.
Plus that crucial tax distinction we mentioned.
Right. Short-term profits are taxed highly, which is a major hidden cost for the rapid traders. Position traders, by contrast, benefit from that lower long-term capital gains tax rate, which dramatically reduces their tax bill at the end of the year.
This all leads us to the reality check. We know that many beginners jump into day trading thinking it's the easy, fast way to make money. They're fueled by stories of quick riches they see on social media.
But the evidence shows the complete opposite. Robust academic studies, they typically put the number of day traders who are consistently profitable over the medium to long term at less than 15%.
Less than 15, so 85% or more lose money.
The vast majority of people who attempt it lose money, and those who trade more frequently are statistically more likely to suffer those losses.
We want you to understand that day trading is extremely hard. because it demands intense focus, emotional control, and the ability to compete against institutional players and these high-frequency trading algorithms.
You're not just fighting the market, you are fighting the best, most automated financial minds in the world.
So success in active trading, no matter which rhythm you choose, it's not guaranteed.
Not at all. It requires exceptional skill, discipline, and a deep understanding of market trends, technical analysis, and most importantly, risk management. You have to understand how much you can lose before your account is gone.
So what's the key takeaway for you, the learner, trying to decide where to start? Before you pick any style day, swing, or position, you need to be really honest with yourself about three crucial, non-negotiable things.
1. How much time do you really have to devote to monitoring the market? If you have a full-time job that prevents you from watching charts all day,
Then day trading is probably out.
it's out. 2. How much stress can you handle without letting fear or greed take over your decisions? And 3. How much money can you genuinely afford to risk while you're learning?
Because initial losses are a very real probability.
A very real probability. And that money should never be capital you need for living expenses or for retirement.
It seems like starting with a slower approach, like swing or even position trading, gives you valuable time to develop that essential discipline and market knowledge before you ever attempt the intense, high-stakes speed of day trading.
Absolutely. Learning to manage volatility over weeks is much, much easier than learning to manage it over minutes.
A really important point to end on.
Remember, all active trading strategies, from scalping to position holding, come with high risk, emotional stress, and high transaction costs. Success requires discipline and skill, not just luck. You must have a solid risk management plan in place before you ever open your first trade.
If you're a beginner and want to explore which trading style might fit you, you can take our free beginner trading quizzes at trendlinegala.com.
It's a great place to start thinking about it.
Next time, we'll talk about the difference between getting lucky and actually having a trading skill and why so many beginners don't realize which one is happening.
That's a big one. It's a very important topic.
Thanks for joining us at Trendline Gala.